Interest rate outlook. So in the recent past, we have seen for the last few months, we have seen across the globe yields have gone up, and we have seen the central banks across the globe tightening the monetary policy by raising the interest rates, policy rates, plus reducing the liquidity from the system. So this has been on the back of red hot inflation that we have seen, and yesterday that inflation in the US came at 9.1%, and also in our markets, in the domestic market, we saw inflation above 7%. So the recent policy measures by all the central banks have geared towards controlling inflation, as it is believed that for a durable growth one needs to have anchored inflation, and that's why we have seen that all the central banks have been raising rates. RBI has already raised rates by 130 basis points. So if you calculate, it is 40 basis point when they moved it from the reverse repo from 335 to 375, the STF rate, then another 40 basis points when they met on 4th of May, and then again 50 basis points. So the entire policy rate hike has been of 130 basis points. But what is that RBI would continue to hike the rates substantially, or they may pause? Will they go beyond 6%, or they will pause somewhere around 5.5%? The answer to this lies on how the inflation trajectory is moving, and that would largely depend upon the further on the next quarter prints on the CPI. Looking at the data at this point of time, a lot of commodities have already corrected. If you see, most of the even the crude oil has come below $100 a barrel. We have seen the various other commodities correcting by 30 to 40%. So it appears that the supply side constraint that we were looking at a few months back has started to ease off, and that's why the commodity prices has started to come down. And if this happens, then input price pressure would start to reduce, and then that is a point where we believe the inflation could start to peak out, and that's what it appears as this point of time, and that is what RBI is actually looking at. So if it is nearer what I just mentioned, then RBI may take a pause and may hike the policy rate by from 490 to say another 60 basis point to say 5.5, and they may pause. But even if they increase the policy rate to say 5.5, even then our yields, which 3 to 5 levels, which are at say 7 to 7.5, 7/4, looks quite attractive, and it is a level which one can invest at this point of time. Also, if RBI starts to pauses at 5.5 and inflation starts to come down thereafter, we believe that that could be the neutral rate, or the terminal rate where RBI will take a pause and look for more data and more inflation prints to take further policy measure in terms of tightening. So the rates may have started to peak out, I would say. Not only I would say that at 740 levels, it can still go up, but the zone of elevation, I would say, is started to crystallize. So from here, this is a very good levels for somebody to invest in any debt fund from 2 to 3 year perspective, because markets would continue to remain volatile in the near term. And however, as we see that the impact of rate hike starts to come in, we could see inflation coming down, and then we could see that over a period of time interest rates would start to go down over a period of 2 to 3 years. So from then on, one can see the inflation to remain anchored at what RBI's comfort zone is at 4% plus minus 2%. So it would remain within that zone between 4 to 6%. From rates perspective, it is an ideal time for anyone to come in a debt fund and lock in at these elevated levels. Yes, there cannot be any point estimation that 10-year may touch 8%, 8/4, or it can remain at 740. What we believe is that these are very good levels for investors to come in a debt fund. So that's what in a nutshell the rate view we have at this point of time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.